did send that out. Better check. Oh, cool. Good. Timothy, how you doing?
I'm doing good. How are you, Dr. Cudd?
I am surviving like everyone else.
Yeah, no joke. Making do.
Yeah. Weird times, huh?
Very weird.
Yep.
Very, very. I've been working from home since last Monday, so that's been different.
Were you're able to?
Yeah, well, yeah, I have my laptop, but I'm living in an apartment right now, so I don't really have like a workstation to set up at, which is kind of frustrating, but it just kind of
Maybe, but
did.
you can jimmy rig something. You have a kitchen table, you have a workstation.
Right, yeah, that's what I'm working from right now.
Yeah. It's better than going in and catching this thing.
Well, I got married in December, and my wife has been working on the infectious floor or infectious disease floor.
She's on the front line.
Yeah, she's in the front line, so if I catch it, it's going to be from her anyway.
Well, the good news is you guys are young, you're healthy.
Right. So they're saying that's pretty good for as far as this is concerned.
It's still not something you want to get, but
Right.
you'll survive it.
But yeah, it threw off everything. I was glad to not be a senior right now, to be honest. Get your whole second half of your semester taken away.
Well, I have three daughters,
Uh-huh.
and the middle one is not married, but she's had a boyfriend for 15 years.
Right.
Why they don't get married, I don't know. But he is a physical therapist. He just got furloughed.
Really?
Well, the physical therapy clinic, well, he's actually what's called a PTA, physical therapy assistant.
Right, okay.
And their business dropped to 40% because
Of this.
most of the type of things you go in for physical therapy are the product of elective surgery.
Right.
And of course, everyone's putting that off.
Gosh. Yeah, it's gonna last for a while, I think. They're making it sound, the conference calls I've been on make it sound like they think we're gonna be working from home for a couple months, maybe.
Couple of months.
Yeah,
Uh,
definitely through April.
I'm not trying to depress you, but probably 18 months.
Really?
Well, Fucci, is that correct? The expert in Washington on all of the infectious diseases.
Uh-huh.
I'm sure I'm mispronouncing his name. Maybe it's Fuchs, whatever. But he is, and the other experts are saying we're 18 months from a vaccine at the earliest.
Oh my gosh.
Oh, they've been saying that for weeks now.
Yeah.
So I get a little amused when I see, well, not amused, but
Right.
fascinated when I see these people talk about extending things for another 2 weeks or 3 weeks. You know,
That's what they keep saying now. Is we're gonna extend it for a couple more weeks and
yeah.
play it by ear. That's what they always say. We're gonna play it by ear.
Jim, what do you do?
I'm a financial analyst at Raytheon.
Cool. Very cool.
So I'm over in Forest, which it's been nice. I haven't had to commute. So.
And you're also in the type of position where I don't think there would be a drop off in the work.
Right, and that was something I was thankful for. It shouldn't affect me, and it's not going to affect my wife. So I think we're going to be okay through all of it.
Yeah. You know, the dean's wife is a nurse.
Really, I did not know
Yeah.
that.
Yeah.
Okay. I bet she's got a bunch of. They're not really telling like Ashton. They haven't gotten much information about it besides don't go in there but 4 times a day and wear a mask.
No
But
kidding.
yeah, somebody else.
Yeah, Kirsten. She may be your competition.
Really?
She's a good student and great.
Oh, these first 2 weeks have been tough. I've been trying to figure out how we're gonna. Working has been taking longer just because we're having a VPN from home and the connection is so slow. So I've been having to
Really?
work a little later.
Well, your company maybe they'll cover an upgrade.
Yeah, well, they did this week. Last week was bad, and then over the weekend they upgraded it, and it's been this morning I could tell a big difference, so that was nice.
We switched to C-Spire about a year ago, and huge difference.
Really?
Yeah, we were on AT&T Uverse.
Uh-huh.
Hang on a second, I just heard a funny. All right, I don't think our security system went off, but. Okay.
Ash, he thought that was him. Yeah. I don't know how. Yeah.
Whatever it was, false alarm.
I think it was my computer pinging.
Ah. Do you know the very first class meeting I had online with a graduate class was spring of last year in January. I bet I had 30 students. It was 65-41. And I had students in Malaysia and all over. Anyway, I'm sitting upstairs. I'm in the 3rd floor of our house. It was the bedroom I was using. And all the tornado sirens go off.
Okay.
And I could see the expression on my students' faces. And just by their expression, I knew whether they were in the Jackson area
Right.
or off in another state or another country. It was something. Tanisha, good evening.
Good evening.
Kirsten, can you hear me?
Yes, I can.
Cool. I can't see you, but that's not essential. The thing that's essential.
Okay, I can see you guys though.
That's perfect. You need to be able to see me because you need to see me to be able to see the PowerPoint slides and anything else I work. And I've got somebody that's on a phone, probably a smartphone.
That's me as well. I have to connect in 2 different ways for some reason.
I tell you what, I wish you would kill one of them because what happens when you're on 2 is you get an audio feedback loop. Do you follow what I'm saying?
Yeah, is it messing up the connection?
Well, it's not yet, but when students have tried to do that, what it would mess up is audio. There'd be an echo going.
Okay, well, let me know if it does happen.
Okay.
Because I'm watching you on the computer, but I'm talking to you through my phone.
Gotcha. Okay.
But I muted my computer so there wouldn't be any feedback on my side.
Then that's why there's not. Okay, that works.
Okay.
Well, I know one thing I think you guys will like. I think tonight's going to be one of the shorter meetings. Now, I've said that before and it's backfired on me, but we'll see. Guys, I've got 5 after. Let's go ahead and get started. The topic for this week, you've got 2 chapters, one that deals with bankruptcy and one that deals with distribution policy. And it's so straightforward, we're not going to spend much time on it, but let's go ahead and get rolling. Now you have these slides, do you not?
Yeah, we have them.
Cool.
Yes.
Okay. There's really only two outcomes in the bankruptcy chapter that the author addressed, so that's all I addressed, and that's reorganization. If you do it through the courts, it's called Chapter 11 bankruptcy. If you do it informally, it's called, I'm drawing a blank on it. Well, it's in your notes. I'm not going into the detail of the terms tonight. My goal was in these Zoom classes is to give you one straightforward problem that's the heart of the chapter that covers some more difficult things to understand. And then you can get a lot of descriptive material, either from the slides themselves or from the, that is the posted slides to Moodle, or from the YouTube videos that cover the subject. And I think you may have already figured out they're not perfectly in sync. I made the YouTube videos a year and a half ago. The subject matter hasn't changed, but I changed up some of the examples with the slides, honestly, to give you a little bit more variety. This way you get to see multiple examples of the same thing. But anyway, I'm just talking. Selfie Corporation has filed for bankruptcy. It's unable to pay its bills. It reached out to its creditors for an informal reorganization. They wouldn't buy it. So it's gone to the court. And the bankruptcy judge, in an attempt to avoid immediate liquidation, has solicited bids from other companies. Only one bid came forward. Frame It Corporation has made an offer to take over Selfie Corporation. Now, this is what Selfie's balance sheet looks like right now, the right-hand side. As you can see, and these are in millions, they owe $5 million in accounts payable, $2 million in accrued wages and taxes, and I won't bore you by reading them. I know you can read. I would like to point out the subordinated debentures are subordinated specifically to the senior debentures. And you'll see why that matters in a little bit. Now, there's specifically their offer. They'll cover the bankruptcy attorney fees, whatever they are. They'll assume the first mortgage bonds. And they will either assume or pay accrued wages and taxes. They'll offer the remaining unsecured creditors 50 cents on the dollar. And of course, the stockholders will get nothing, which is normal in a bankruptcy, unless the federal government bails you out. So if you take another look at that balance sheet, you'll notice the accrued wages and taxes will be assumed, as will the mortgage bonds. So that leaves 4 groups of unsecured creditors: accounts payable, notes payable, debentures, sub-debentures. If we look at their initial payoff, which is 50%, the accounts payable holders would get half of their claim, $2.5 million. The notes payable holders, $1.5 million. The debenture holders, $4.5 million. And the senior debenture the junior debenture or they're also called junior. Subordinated junior debenture holders would get half of their claim, $2 million. And that adds up to 10.5 mil, which is half of the 21 mil book value claim. Now, this is before the subordination feature. The way the subordination feature works is the subordinated debentures are subordinated to the senior debentures. What that means is every penny of the subordinated debenture claim is shifted to the senior debenture holder claim, or shifted to the senior debenture holders. So if you'll notice, if they shift every penny to the senior debenture holders, the senior debenture holders still are only recovering $6.5 million. Sorry, guys. There is a glitch in, there it is again. I've read about it. Practitioners are going nuts over this. They'll be in the middle of a presentation. If you try to write on the slides, that's why usually you'll see me go into a whiteboard. But at any rate, all 2 million of the subordinated debenture claim goes to the senior debenture holders. So after you take the subordination feature into account, I should have just typed this out instead of left it to be handwritten. The payment for accounts payable, they get half of what they were owed, so their recovery rate is 50%. Same for notes payable, they get half, so their recovery rate is 50%. The subordinated debenture holders get the 4.5 they would have gotten plus the 2 the subordinated debenture holders would have gotten. So they're recovering $650 of the $9 million they're owed. So their recovery rate works out to be 72%. And of course, the subordinated debenture holders get zip. The recovery rate for the mortgage bond holders is 100% in that Framingham Corporation will assume the mortgage bonds. So if Framingham Corporation is financially viable, they would expect to eventually be fully paid. Likewise, the accrued wages and taxes are fully paid. So their recovery rate would also be viewed as 100%. It's pretty straightforward, pretty quick. Do you have any questions on what I just flew through? Keep in mind this meeting is being recorded, and I'll post it to YouTube probably tomorrow. Zoom makes a recording, sends it to me. That takes a little while, and it takes a little while to upload it to YouTube. Then I'll post the link in your on your Moodle page. No questions. Tell me something. What does the subordinated debentures, what do they do? Who do they help? Were they not subordinated, the recovery rate for the senior debenture holders would have been 50%. Instead, it's 72%. Often when a company issues bonds, like mortgage bonds or debenture bonds. They may write into the bond contract language that prevents the company from issuing any senior or even equal level additional debt. Any additional debt they have to issue would have to be subordinated. I'm keeping it simple, but so do your authors. All right, you're a silent group. I'll move on. The alternative to reorganization is liquidation. If Selfie Corporation is liquidated, its current assets, which would be cash, marketable securities, receivables, and inventories, have been estimated that they would sell for $4.65 million. The fixed assets could be sold for $4 million, but as you might expect, the fixed assets are pledged as collateral on the mortgage bonds. And if Selfie Corporation is liquidated, they would incur $0.2 million in trustees' fees. And the trustees are just the attorneys that overlook the process. Again, that's the same balance sheet I showed you earlier. I don't know why I thought it'd be good to show it again, but there it is. When you're looking at liquidation, you start with the secured creditors. In this case, the only secured creditors are the mortgage bond holders. They have a $6 million claim, but the fixed assets would satisfy $4 million of that claim, leaving them with $2 million in the form of an unsatisfied claim. For the unsatisfied claim, the mortgage bondholders would get in line with the other general creditors. So in liquidation, first step, you look at the secured bonds, the mortgage bonds. If you'll notice, there's only two categories of assets to sell. Fixed assets, that all goes to the mortgage bondholders. If, in fact, the fixed assets were sold for more than $6 million, then the excess would be tossed in with the proceeds from the sale of current assets and divvied up among the general creditors. But that's not the case here. Speaking of case, you can assume in your case that the fixed assets sell for less than the mortgage bond claim. I think in your case, you may have first mortgage bonds and second mortgage bonds, but you can assume they will sell for less than the total claim of the mortgage bond holders. Otherwise, you'd be writing a lot of nested logical ifs in your spreadsheet, and I'm trying to keep it simple. So, current assets would be sold for $4.65 million. Guys, the reason I'm writing so slowly, if I write slowly, it doesn't dart. Trustees' fees would be deducted. Accrued wages and taxes are what are known as senior creditors. If you look in the book or in the slides near the end, you're provided with a hierarchy of claims. Who is paid first? The key thing for you to remember is that the accrued wages and taxes are considered senior creditors, so they're going to be paid before the general creditors. The general creditors are only one rung above the stockholders. So that leaves, if my math is good, 3.45 million to be divvied up or prorated among the general creditors. Now, the general creditors consist of course, notes payable, accounts payable, debentures and subordinated debentures, but you'll also notice the mortgage bonds for their unsatisfied claim of 2 million also get in line. So that's a total unsatisfied claim of 23 million. And the general recovery rate, they've got what? 3.45 million to spread over the general creditor claims of 23 million. That's a recovery rate of 15%. Believe it or not, in liquidation, that's on the high side. Most studies I've seen show the average recovery rate on unsecured creditors is 11 cents on the dollar. So if we now take each of these unsatisfied claims, multiply them by that 15% recovery, we get how much would go to each of these unsecured creditors. 0.75 mil, 15% of the 5 million owed to accounts payable. They would receive 0.75 mil, the notes payable 0.45 mil. Again, I should have just typed this in. But recall that the subordinated debentures are subordinated to the senior debentures. So every dime of what they would have gotten will go to the senior debenture holders. Notice the subordinated debentures are not subordinated to all other debt. They're subordinated to a specific class of debt. In this case, it's debenture bonds. So what would be the final recovery rates? Well, the accounts payable holders and notes payable holders would end up getting 15%. They would get the general recovery rate. There were no assets placed as collateral on their claim. There is no other debt subordinated to those two sources of claims. The mortgage bond holders who have a claim of 6 million would get 4 million from the sale of the fixed assets, plus they would get 0.3 million from their participation as a general creditor. And on their $6 million claim, that would produce a recovery rate of 82%. The debenture bondholders would get their prorated portion plus what would have gone to the subordinated debenture bondholders. And on their claim of 9 million, that's a recovery rate of 22%. And then, of course, The subordinated debenture holders get nada. I have flown through this, but it's pretty straightforward when you look at it. Once you start working some of the problems in the book, remember, you have two choices. You can, if you don't get the check figure in Appendix B in the back of the book, or if you work some of the problems that are in green slides in your PowerPoints and you don't get the check figures, you're welcome to do what you've been doing with your quizzes. Try to work it by hand, take a picture with your cell phone, send it to me. And I'll be glad to look through it, show you where your mistake is, if it's your mistake rather than the author's or mine. Now tell me something. If you are a mortgage bondholder, see, these creditors are going to get the vote. Typically, their vote would amount to a prorated portion of the book value claim. You know, if you're owed more money, you've got more votes. But if you are a mortgage bondholder, would you vote for reorganization or liquidation?
Liquidation, if you're a mortgage, right?
Well, that could. Your recovery rate with reorganization was 100%. Assuming Frame It Corporation is financially viable, you would expect to recover all of your claim. With liquidation, what was it, 82%? I would expect the mortgage bondholders to vote for reorganization. They'd rather recover all of their money than just 82% of it. Now, they wouldn't recover it immediately, but Frame It Corporation, in assuming the mortgage bonds, you would expect them to fully pay them back. Now, what about the debenture bondholders? Which way would you vote? With reorganization, wasn't the recovery rate, it was 50%, wasn't it? That was the offer from Freeman. With liquidation, what was it, 22? If I were the mortgage bondholders, I'd vote for reorganization. If I were the debenture bondholders, I'd vote for reorganization. You recover more of your money. Does that make sense to you? And silence fell over the land. Kirsten, you still with us?
I am.
Cool. Well, see, I see the faces of the other students, and I see an icon for a phone for you, so I just wanted to be sure.
Yes, I'm still following.
Guys, it's driving me nuts trying to think of the term. The best outcome when a company can't pay its bills is to be reorganized internally. That is, to come to some agreement with its creditors so they don't go to court. as you'll see when you look through the notes, there's informal reorganization, and that's the term I'm drawing a blank on. And then formal reorganization is when you go through the courts. It's chapter 11. There's informal liquidation. That's called assignment. And formal liquidation, when you go through the courts, is called a chapter 7 bankruptcy. And as you go through the slides, the full slides, you'll see the pros and cons of each of these. How are you guys holding up? I don't know about you, but the stress it's heavy on my end anyway. All right.
Well, for me.
Good. How many of you are working from home? Well, how many of you are working and working from home? I know Tim is. How many
My job just told us today that we are working from home starting tomorrow.
Not furloughed, but working from home. That's great. That's good news.
Yeah.
It's good you have a job where you can do that.
Yes, that is true.
Guys, I have no idea what I just did, but I've got a weird looking, there. That's what I get when I start pushing buttons. That's the heart of the bankruptcy chapter problems. There are other forms of bankruptcy. There's a chapter 13 and some other stuff. You don't need to worry about that. Problems will be limited to reorganization and liquidation. And quite honestly, you won't know the distinction between the two in terms of how you work it out as to whether it's formal reorganization or informal. Formal liquidation or informal. You work out the problems the same way. All right. Shall I move on to the next chapter?
Yes.
Yes.
The one other chapter we're covering this week is distributions. And they used to call this the dividend chapter, dividend policy, but corporations today have shifted a lot more to buybacks than to cash dividends, because if you're a shareholder, you're paid a cash dividend, you pay taxes immediately on it. If instead the company uses its profit to buy back some of the stock, the idea is the buying pressure will drive the value of the stock up, and you get your gain in the form of a capital gain. You know, if I own stock in Microsoft and they buy back shares, drive the price up $5 a share, I don't pay taxes on that until I sell the stock. Okay. Pretty much everything in the distribution chapter is easy, straightforward to understand. The one thing that has a little bit of math to it is what's called the residual distribution theory. It's basically tying distribution policy to capital budgeting. The premise is you invest in the projects that are good projects, then distribute the residual to the shareholders. For example, let's say we've got TC, Top Cat, I guess, Corporation. Their long-term target capital structure is 30% debt, 70% equity. That's how they want to finance projects. This year, they have net income of 50 million. They've got 20 million shares of stock outstanding, and they've got 3 capital budgeting proposals before them. Projects X, Y, and Z. You're shown the cost of each project. X would cost 40 million, Y would be 20 million, Z would be 25 million. That's the initial outlay. And then you're shown the net present value of each project. Which projects would you say are acceptable? What do you want the net present value to be for a project to be acceptable?
Positive.
Positive. So they would accept projects X and Y, which would require a total outlay of 60 mil. They would reject project Z because it's got a negative net present value. It's a bad project. So they've got $60 million worth of projects they want to finance. Since they want to finance 30% of that cost with debt, they want the other 70% to come from net income. So they would accept projects X and Y. I just went over that on the prior page. The capital budget would be 40 mil. No, 60 mil. Good grief. So the question is, how much equity funding will they need if they're going to finance 70% of the projects with equity? Their equity funding, since it's 70% of the project cost, would be 42 mil in equity. They get the other 18 mil of the 60 from debt. So how much would they have left to distribute? That's not supposed to be there. Go away. Oh my goodness. Okay. There we go. Okay. They've got net income of 50 mil. They're going to use 42 mil for the projects. So that leaves 8 mil to distribute. If they're like most companies, although those numbers are small, I didn't want to put a bunch of zeros and use tiny font. But if they're like most companies today, they would use that money for stock buyback. But if they were to distribute that 8 mil in dividends, then the dividend per share $8 million spread over, what was it, 20 million shares. That would work out to a dividend of 40 cents per share. And a payout ratio, they'd be paying out 8 million of their 50 million in net income. And that would be a payout ratio of 16%. The shortcut formula that your author provides is this. The distribution will be the net income of 50 mil. Minus the 70% of the project's costs that we fund with equity times the project cost of 60 mil. And that's a single formula method of coming up with the 8 million that they would distribute. Maybe I'm going through this too fast. I'm surprised that I'm not getting more questions, but hey, maybe it's getting across. I'm going to go with B.
You're just doing a great job.
Yeah, right. All right. Change the problem up. What if their net income's not 50 million, it's 20, but they want to maintain that $8 million dividend? Companies that pay cash dividends try to pay the same dollar dividend quarter after quarter for quite a while before they eventually change it, typically to raise it. And any shortfall in funding, they're going to cover by selling more stock. Now, I'm keeping the numbers small just to keep this from blowing up in our faces. But if we run this through that distribution policy equation, pardon me. They're going to distribute the net income of 20 mil. Again, finance 70% of the 60 million in projects with equity. That produces a distribution of a negative, good grief. Of a negative 22 million. So the question is, how much would they have to sell in stock to both cover their dividend and this shortfall? They'd have to sell enough stock to cover the shortfall, which is 22 mil, plus the dividend they want to pay, which is 8 mil. So they'd have to sell 30 million in stock to cover the shortfall. Obviously, no corporation would sell a stock issue that small, but these are how the problems are set up. If you want something more realistic, add a couple of zeros to every number. And that is really the only tricky thing about the distribution chapter. They go through a lot of different theories. Bird in the hand theory that supports cash dividends. A tax preference theory that supports stock repurchases. They also cover, I do too in the slides, something called the M&M theory. There is actually an M&M theory on capital structure. There's an M&M theory on dividends. If you were working on a master in finance, I'd go through this thoroughly. Since this is an MBA, really you can skip M&M. M&M, Franco Modigliani and Merton Miller. That's where they came up. They came up with this theory. And of course, we couldn't resist calling it the M&M theory. What it goes to show, again, you're not responsible. I'm just giving you a very shortcut version. In a perfect world, where there are no taxes, it's pretty perfect, huh? Where there are no transaction fees, where everybody has access to all the same information. Dividend policy is irrelevant. If I could spell. In other words, dividend policy has no effect on shareholder wealth. It's an irrelevant decision. Whether the company pays 20% of its earnings out in dividends or 80%, stock values are unaffected in their perfect world. Their assumptions were ridiculous. No taxes, everybody can borrow an unlimited amount at the risk-free rate. There is no such thing as bankruptcy. They had a bunch of wild assumptions. But it was useful in showing us how things would work. It's kind of like learning to throw a football. You first learn to throw it in a vacuum where there's no air resistance, no gravity, no nothing. Then you relax those assumptions to get closer to reality, and it shows us how this really works. Guys, that's all I have. Do you have any questions? Told you it'd be shorter. Of all the chapters you have, the distribution policy chapter is the easiest by far. And again, when you set up the spreadsheet for your bankruptcy case, you do not need to worry about the case where fixed assets might actually sell for more than the fixed asset, more than the mortgage bondholder claims. If I were going to have you do that, you'd have to build in a bunch of nested logical ifs, and I'm not trying to do that to you. You're quiet. I guess these are times for quiet. Do you have any questions about any of this?
I'm good.
No, yeah, I'm good. Or is our exam next week or is it in 2 weeks?
Say again.
Our midterm exam? When is it?
Week after this, the next, yeah, like next Saturday.
Okay.
You can look in Zoom and it'll, if you just put your cursor on the midterm exam, it gives you the window, the dates, the 2-day window. I think it's April 4th and 5th, is it not?
Yeah, that's what I think. Yes.
Today is the 23rd, so that would be 2 weeks. It's 2 weeks away.
Okay. Okay.
Anything else, guys? All right, I keep dragging this.
Okay.
I'll end the meeting. You guys be safe.
All right,
You
you too.
too. Thank you.